Welcome to Global Money Talk, brought to you by SamPro.TV. Greetings to all of our viewers from across the United States, Korea, and the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me again today is Dan Ha, partner at Karani Asset Management. Dan, welcome to the show. Good to see you here again.
Thank you very much. Thanks for having me.
It's been a pretty interesting week. I led, I think, in the market by Nvidia's earnings. You could argue that Nvidia is sort of the muse of the market right now.
Right.
So what are you thinking after you've seen those earnings?
Yeah, so Nvidia's earnings report was definitely an exciting report. The stock price action following the report, not so much. As we know, the stock was pretty much flat yesterday. It sold off a little bit after the earnings report, but nevertheless, it was pretty flat yesterday. I think this is actually the Nvidia results, and the subsequent price action is a great reminder that investing at the end of the day really is about expectations versus reality. Price reflects, the price you pay reflects whatever the expectation is by the market at the time. The move in the price reflects reality. And more precisely, the move in the price reflects new expectation, which is influenced by, the perception of the reality. But nevertheless, the price at any given point is going to be reflecting the expectation. So, for Nvidia, it was an exciting report for a company whose stock was priced for excitement. Therefore, the results, the gangbuster results, didn't really move the stock. What I thought was interesting was, what I'd like to point out is yesterday morning, actually, ag equipment maker Deere reported as well. Last week when I was on the show, I briefly mentioned CNH, another industrial or another ag equipment company, and sort of the David Einhorn investment thesis on why it was good value to be buying CNH now, even though the company's actually kind of struggling because the ag cycle is going through a downturn. Deere reported revenues that were down something like 30% year over year, and profits that were down almost 50% year over year. And what happened to the stock? The stock was up 8% yesterday. So, here on the one hand, you have Nvidia, whose revenues and profits were basically doubled from a year ago, and the stock basically was flat. And Deere, whose revenues and profits were down a lot, profits to the tune of almost basically getting cut in half, and the stock is up, or the stock was up 8%. So, it's an important reminder, I think, that again, investing is about expectations versus reality, and it's always for everyone to remember that when you're buying a stock, what you're really buying, or the price that you pay, what you're really paying for is the expectation that is embedded in the stock, which is something that is very important to remember, because it's not just the fundamentals that you have to think about. You have to think about what's expected in the price.
As a sell-side trader, sometimes I would say that Nvidia is not going up a lot because there are not a lot of shorts. Who's going to be short Nvidia, right?
Right.
That'd be a pretty brave and perhaps foolhardy person, but it might be a lot of people who were short Deere, and something came out that was better than expectations, and
right.
Everybody's scrambling to cover.
Right.
You have a big short there in Deere. But you said something about that the Nvidia results were exciting.
Yes.
I want to just get a little bit more into that. Like, what was exciting to you about the earning, the whole report?
Yeah, no, there were lots of things to be excited about in that report. I want to highlight a couple. First, it was about inference. So in AI, there's training, and then there's inference. What that means is, you have to train the AI model. It's like training the brain. Inference is then applying the brains to real-world situations. It's the application. And you need the computer systems, the capacity to be able to do both. It is generally or widely understood that inference, the compute necessary to perform inference, is not as intense as the compute necessary to do the training. So it takes far more compute power and intensity to train the brain than to actually go and use the brain. When it comes to Nvidia, everyone is wondering, or many are wondering, including myself, when will competition finally get to them, right? We all know right now, Nvidia basically has no competition. But a lot of people, a lot of investors are wondering, well, that can't last forever. When will competition finally get to them? We know that when it comes to training, Nvidia has zero competition right now. People are still lining up, companies are still lining up to buy the product. Demand still way outstrips supply when it comes to buying the latest and greatest chips to do the training. But some people do view inference as an area where Nvidia will probably face competition going forward. Because it's not as compute intensive, you don't have to have necessarily the latest and greatest, the most expensive, fanciest chips and systems to be able to do that. Which means that there's probably room for some of the newer players, players that are not as cutting edge, to actually compete in that market. Jensen Huang actually commented on that specifically on the call, and I actually would like to read you a quote from the earnings report. Jensen Huang said, "But remember, simultaneously, we're seeing inference really starting to scale up for our company. We are the largest inference platform in the world today because our installed base is so large. And everything that was trained on Amperes and Hoppers, inference incredibly on Amperes and Hoppers. And as we move to Blackwell for training foundation models, it leaves behind a large installed base of extraordinary infrastructure for inference." What he's saying is, the Nvidia chips that the AI models train on is actually basically the best chips for those models to perform inference on. So, and companies have to be buying the latest and greatest chips to do the training, to make sure that their AI models are trained on the latest and greatest, hardware technology. But when you actually run inference also on the same technology, the results are that much better. So to give you an example, it's like if you've trained as a driver, you're a race car driver, and you trained on Porsches. Later on, when you actually go into competition, yeah, in theory, you can drive other cars and still be a great driver and still expect great results because you, regardless of the car, is a great driver, or you are a great driver. But when you actually get to compete on the same car that you trained on, you could expect the results to actually be better. And that's what Jensen Huang is talking about. And also the reference to Blackwell, Nvidia has basically committed to launching a new product every year, meaning every year they're going to come up with the latest and greatest chips. We know that the big companies have to be buying these chips if they want to make sure that their AI models are trained always on the latest and greatest, which means that the chips that they bought, the latest and greatest chips that they buy this year, a year from now, is going to become yesterday's chips. What do you do with yesterday's chips? What do you do with yesterday's computers? Do you just trash them? No. What they're saying is you can use yesterday's chips for inference. So train on the latest and greatest, and when they become last year's chips, you can then use them to run inference. So what you're paying for now, you're actually going to be able to use it later on for inference. So, this idea that new competition or new competitors may emerge in inference because maybe they'll come up with a cheaper solution, purpose-built chip for inference, and it's cheaper, so you should buy these chips. Well, if I'm the company that already bought these chips, that I'm already sitting on last year's chips that have already been paid for, I can just use those to do inference. And even though those were more expensive chips when I first bought them, nothing's cheaper than stuff that's already been paid for. So there's very little incentive for Amazon AWS or Microsoft Azure to go out and buy these purpose-built inference chips that may be cheaper as a new product, but I'm already sitting on an installed base of last year's chips that have already been paid for, which by the way, apparently, supposedly, will actually even perform better. So I have very little incentive to actually buy from the new guy. It'll change when the volume of the demand for inference, when the volume gets to be so big that I as a company can no longer rely on this year's chips being enough to supply when they become last year's chip, a year from now, when that is not enough to meet all the demand for inference, then at that point I'm going to need to go out and probably buy some more, and at that point I'll probably buy some cheaper ones. But in that scenario, still, I'm not replacing the stuff that I already bought. I'm buying in addition. So, and oh, by the way, when I use the stuff that I've already used this year to do inference, it's also software compatible because Nvidia is very committed to making sure that the various generations of their products are all compatible on the same software. So, it's kind of hard to see a scenario under which Nvidia comes under huge competitive pressure, which is probably why the stock is priced the way it is. And that is not to say that Nvidia will never face competition, but certainly as we sit here right now, it's kind of hard to see where that's going to come from. And that's really exciting for Nvidia.
It's as if their moat is wider and deeper than people feared in terms of, well, you can use, I guess Blackwell is 2025, and there's going to be another chip in 2026. I wonder if they've actually named it yet. Probably not.
No, they have. To my knowledge, they have not. But yes, that's correct. And I do want to emphasize that just because it's not visible today, that it's not possible, right? That's important to remember. Usually, it's the unforeseen that does the most damage. Like we said, it's about expectations. And when investors don't expect any competition, by definition, when that unforeseen competition sort of pops up out of the left field, it's going to be very damaging to the stock. So I don't want to underplay the risk of competition.
Sure.
However, as we sit here today, when you ask me, how do you see competition playing out? It's kind of hard to see as we sit here today.
Right.
Yeah.
You worry about the unknown unknowns. And before, there are a few other topics I want to get into. But last question on Nvidia.
Yeah.
I mean, I know you're not the analyst, so I'm not going to maybe ask you for a target, but would you hazard a range for this time next year for Nvidia?
Oh, for the stock price? I won't get into that. I won't get into that. But I mean, I actually had a conversation with a friend of mine yesterday about this. Right now, it seems like the AI hardware market is one where the hardware innovation is actually happening very rapidly. I've made this comparison at a different time when I was on the show. I kind of compared the Nvidia product cycle, and the install base development to Apple iPhone. In the early days of the iPhone, a lot of people upgraded their phones every time a new model came out, because the differentiation between, say, iPhone 3 and iPhone 4, or even iPhone 4 and iPhone 4S, was big enough that you always wanted to have the latest hardware. Eventually, it got to a point where, I mean, there are plenty of people who are still on iPhone, 13, 14, or 15, with no plans to upgrade to 16, because the hardware, the difference in the hardware capabilities, it's just not as, the difference isn't as much as we've gone to, 15 and 16 and probably 17 and 18. But at that point, at this point, it's really more about the software ecosystem. But in the earlier days, the hardware differentiation was big. It feels like Nvidia, like I said, has committed to launching a new product every 12 months or every year. And my bet is that whatever product, whatever they call it next year, that's going to be, the hardware capabilities are going to be way better than, that's my prediction, than Blackwell. As Blackwell, as it was the case for Blackwell versus Hopper, for instance. So, as long as that continues on, the demand, or the customers will probably have to continue to buy the latest products, which should continue to drive Nvidia's revenues, or result in robust revenue growth for Nvidia for the foreseeable future. But where exactly next year, I don't know.
That's a great analogy with the
Yeah.
iPhones, and certainly I remember how excited people were to get the new unit lines around the block in Grand Central when I got off the train, but you don't see that anymore. And to
Yeah.
your point, what difference between the 15 and the 16? Maybe you had a 13, now you can go to a 16, but
Right.
you wouldn't have to get one new every year. But I do want to move to the other big tech story of the week, and Google,
Yeah.
or Alphabet.
Yeah.
The Department of Justice is recommending a number of remedies, antitrust remedies, and one of them is potentially forcing them to sell off the Chrome browser.
Yeah.
So, what are your thoughts on what this means for Google in the short, medium, and perhaps long term?
Right. So first of all, it's extremely difficult to know, if not impossible to know, what will happen, right? Predicting the future of business environment is already difficult enough. Predicting the potential outcome of legal situations is extremely difficult. Having said that, I think, basically the market voted with its feet yesterday. I mean, Alphabet stock was down quite a lot on the day when this news came out. So I don't want to underestimate the potential damage to the value of Google, and what, even if some of these remedies or proposed remedies actually end up taking place, I'm sure at best it's status quo for Google, right? And at worst, there will be a damage to the intrinsic value to the Google business, to the Google franchise. Having said that, though, I know this sort of idea of, for Google, at best it'll be status quo, is like the core bearish thesis for Google. Whether it is with respect to the antitrust situation, or with respect to the business, and the challenges that they face because of Gen AI in their core businesses. People often argue that, even if Google successfully fends off the competition from Gen AI, or successfully fends off the government's efforts, at best it's just status quo. So it's like heads you're flat, tails you lose. So you could only really lose on the Google bet. Therefore, it's not a great risk reward. The only problem with that argument is that yes, that's true fundamentally, But that's not necessarily the case for the stock price. We talked a lot about what's being, stock price reflecting expectations. The stock price of Google, in my view, certainly does not reflect champion status. Google currently trades at something like 20, 21 times earnings. For a company that is still one of the most, that is putting up one of the most robust growths, out there globally, with incredible 30+% margin, 40+% margin in the core business, and it trades at 20, 21 times, which is basically about market for the S&P equal weight. That to me does not reflect, market's view that this is champion status stock. So in my view, and Google historically, over the last 7-10 years, traded at something like 30-40% premium to the S&P equal weight. So if Google can successfully defend its position, or even if it can't fully defend this position, and therefore have to give up some, if Google can more or less defend itself, then I think there's no reason why the stock doesn't go back to get re-rated to trading at a premium to the market. And if Google, unfortunately, if they fail at fending off either competition or these government efforts to break it up, then there's obviously downside to the stock too. But right now, the point that I want to make is that the market is already expecting some of this bad news to actually be reality. That's what the price tells me, at least. Therefore, I continue to think that the Google stock offers a decent risk reward. I think it certainly has a place in our portfolio. Would I sit here and say, well, put all your money in Google because it's such great risk reward? I'd never say that with any stocks. But I certainly think the risk reward is attractive enough, given all this sort of negative news flow around it, that the price is actually giving me an interesting or an attractive risk reward to have it in the portfolio.
Just briefly, in the time that we have left, for some of the other big tech sort of companies in the Mag 7 or somebody close to that, any concerns about similar antitrust activities? And briefly, if you can, what position they're in terms of how they're priced?
Yeah, I mean, the only thing I'll say about that is, again, it's too hard to know. But on the one hand, we have a new administration that's expected to be more business friendly and kind of will back off of these large companies and the efforts to try to break them up. But at the same time, we also know that there are voices in the new administration that are concerned about sort of the power concentration among the big tech companies. So whether the environment will be more favorable or more hostile to these large tech companies, frankly, I don't know. The only thing I'll say, though, is that when it comes to AI, which these large tech companies are really leading the effort, software, generally speaking, has proven to be a winner-take-all or winner-take-most type of business. And AI is software. In software, scale matters. Having more data than others matter. Having more, sort of the financial capacity to make investments matter. The efforts to try to break up, currently the leading AI companies are American companies. They're the sort of the super heavyweight companies. The effort to try to break them up and basically take these super heavyweights and turn them into like a bunch of featherweights and lightweights. All right, maybe that will be good to promote competition within America. But AI on the global stage is going to be a super heavyweight match. The Chinese companies or other companies are going to be super heavyweight players. And so the American companies, do we really want to be taking our super heavyweights and turning them into a bunch of featherweights and lightweights? I think that needs to be done with a lot of caution.
That's, I mean, you close with a sort of a great question. I think I want to talk about this next time you're on the show.
Yeah.
It's very important to the future. But that's all the time we have for today. Thank you so much again for coming on the show. And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here on Monday. Have a great weekend.